President Trump declares a trade war on China. Tariffs, sanctions. Tough talk about bringing jobs back to America. But while the president tweeted about America first, America's biggest financial institutions were doing the exact opposite. BlackRock, JP Chase, Goldman Sachs. These giants of Wall Street moved over $1.4 trillion into China during the trade war. Not away from China, into China. How was that possible? Why would they bet against their own country's foreign policy? The answer reveals something fundamental about who really runs the global economy. And it's not the politicians. Let's establish the facts. The timeline here is shocking. March 2018, the trade war begins. Trump announces tariffs on $50 billion of Chinese goods. China retaliates immediately. The trade war is officially on. The rhetoric is aggressive. China has been ripping off America for decades. We will bring manufacturing back. Economic security is national security. But here's what Wall Street was doing. At the exact same time, something else was happening behind the scenes. April 2018, China announces it will open its financial markets to foreign firms. For the first time, foreign banks can own majority stakes in Chinese securities firms. This is huge. China's financial market is massive, the second largest in the world. And it had been essentially closed to Wall Street. June 2018, JP applies to take control of its Chinese securities venture. August 2018, BlackRock gets approval to start a mutual fund business in China. September 2018, Goldman Sachs applies for majority ownership of its Chinese joint venture. While Trump is tweeting about tariffs, Wall Street is filling out applications to expand in China. The numbers are staggering. Between 2018 and 2021, the peak trade war years, here's what happened. BlackRock moved hundreds of billions into Chinese assets. JP increased its China exposure exponentially. Goldman Sachs expanded operations in Shanghai. Other major financial institutions followed total foreign financial investment flowing into China during the trade war, over $1.4 trillion. Not just maintaining presence, not just keeping existing operations, actively expanding and investing during a trade war. The contradiction, think about this for a moment. The United States government is trying to economically pressure China. Tariffs on goods, restrictions on technology, rhetoric about decoupling. Meanwhile, American financial institutions are racing to get deeper into Chinese markets. It's not just ironic, it's a fundamental contradiction that reveals how global finance actually works. Money doesn't care about flags. Money goes where money grows. To understand why Wall Street did this, we need to understand China's strategy, China's calculation. Beijing watched Trump's trade war carefully, and they made a brilliant strategic decision. They realized something. Trump's tariffs targeted goods, manufacturing, agriculture, technology. But Trump wasn't targeting finance. So China offered Wall Street something it had wanted for decades, access to China's massive financial markets. Why this mattered. China has 1.4 billion people, a rapidly growing middle class, trillions in savings looking for investment opportunities. For decades, Western financial firms could only access this market through limited joint ventures where they were minority partners. Now, suddenly, China was offering majority control, direct market access, the ability to actually operate in China. The timing was perfect. From China's perspective, the timing was genius. They were facing pressure on trade, so they relieved pressure on finance. They gave Wall Street what it wanted most, not cheaper manufacturing, but access to Chinese capital markets. This created a split in American business interests. Manufacturing companies supported Trump's tariffs. They wanted protection from Chinese competition. But financial institutions opposed the trade war. They wanted access to Chinese markets. Beijing had divided American business interests. Classic strategy. The regulatory changes. In 2018, China made specific regulatory changes. Foreign banks could own 51% of securities joint ventures, later increased to 100%. Foreign asset managers could operate independently. Market access expanded for mutual funds, and insurance restrictions on foreign investment gradually lifted. Each change was carefully calibrated to attract Western financial giants, while Trump was imposing tariffs. What China got in return? This wasn't charity. China got something valuable. First, they got investment capital, billions flowing into Chinese companies and markets. Second, they got expertise, Western financial techniques and know-how. Third, and most importantly, they got leverage. Once BlackRock, JP and Goldman have hundreds of billions invested in China, they have a vested interest in good U.S.-China relations. Wall Street became a lobby for China engagement, even as Washington pursued confrontation. Beijing had turned America's financial elite into stakeholders in China's success. Now let's understand this from Wall Street's perspective, because they weren't being unpatriotic, they were being rational, coldly, ruthlessly rational. The math was obvious. Wall Street looks at numbers, not nationalism. China's wealth management market alone is projected to reach $30 trillion by 2030. The stock market has 200 million retail investors. The bond market is the second largest in the world. Compare that to mature, slow-growing Western markets. For financial firms, China represents the biggest growth opportunity in a generation, maybe in history. The fiduciary duty argument. Here's what executives at these firms would tell you. We have a fiduciary duty to our shareholders and clients to pursue the best returns. China offers those returns. We can't ignore the world's second largest economy because of political tensions. This is the language of global finance. Obligations to shareholders trump national considerations. Larry Fink, CEO of BlackRock, was explicit about this. He argued that isolating China would hurt American investors by denying them access to growth markets. The political calculation. Wall Street also bet that Trump's trade war wouldn't last forever. Trade wars are politically difficult to sustain. They raise consumer prices. They hurt farmers and manufacturers who rely on Chinese supply chains or markets. Financial executives calculated that eventually economics would force a deal or détente. By positioning themselves in China during the trade war, they'd be ahead of competitors when relations eventually normalized. The regulatory environment. Here's something most people don't know. While Trump imposed tariffs, his administration didn't restrict financial flows to China. The trade war targeted goods, not capital. In fact, the Treasury Department under Trump actually supported Wall Street's expansion into China. Why? Because Trump's team believed American financial firms would benefit and that integrating China into global financial markets might moderate Chinese behavior. There was no unified China strategy. Trade hawks wanted tariffs. Finance officials wanted market access. Wall Street exploited this division. The personal incentives. Let's be honest about incentives. Executives at BlackRock, JP Morgan, and Goldman Sachs are compensated based on growth and profits. Opening China operations could generate billions in revenue. If you're a senior executive, do you, A, turn down the biggest market opportunity in decades because of a trade war that might end soon, or B, aggressively pursue China expansion and collect massive bonuses? The incentive structure made the choice obvious. Risk management. Sophisticated financial institutions also practiced diversification. Yes, US-China tensions were rising, but that didn't mean China would collapse or that relations would never improve. By maintaining and expanding Chinese operations, these firms were hedging bets. If tensions eased, they'd be positioned perfectly. If tensions worsened, they could adjust. From a portfolio perspective, you don't exit the world's second largest economy based on short-term political friction. So what were the consequences of Wall Street's China bet? Wall Street won, financially. The bet paid off enormously. BlackRock's China operations have grown exponentially. JP Morgan's Chinese securities joint venture is highly profitable. Goldman Sachs is expanding in Shanghai. These firms are now deeply embedded in Chinese financial markets, managing money for Chinese clients and facilitating investment flows. Financially, the decision to expand during the trade war was brilliant. American strategy became incoherent. But there's a larger consequence. The trade war was supposed to pressure China. But if American financial institutions are simultaneously deepening China's integration into global markets, what's the actual effect? You can't contain China economically while Wall Street is channeling trillions into Chinese markets. The result was strategic incoherence. Washington said one thing, Wall Street did another. China gained leverage. Every $1 billion BlackRock manages in China is leverage Beijing has over BlackRock. These firms now have enormous financial stakes in maintaining good relations with China. They lobby against aggressive China policies. They argue for engagement. China successfully used market access to create American constituencies with interests aligned with Chinese preferences. The decoupling debate. Today, there's talk about decoupling the US and Chinese economies. But how do you decouple when American financial giants are deeply integrated into Chinese markets? When pension funds and retirement accounts invest in China through BlackRock and Vanguard? The financial flows during the trade war made decoupling far more complicated and costly. The credibility problem. There's also a credibility issue. If U.S. policy can be undermined by financial institutions pursuing profit, how credible are American strategic commitments? Allies and adversaries both notice when Wall Street contradicts Washington. It raises questions about whether America can actually implement long-term strategic policies when short-term profit incentives point elsewhere. The inequality dimension. Here's another consequence people miss. The trade war hurt American workers. Farmers lost export markets. Manufacturers faced higher input costs. Consumers paid more for goods. Meanwhile, financial elites profited by expanding into China. The trade war redistributed costs and benefits in ways that increased inequality. Main Street paid the price while Wall Street made profits. This story reveals fundamental truths about how the world actually works. Money trumps politics. Political leaders announce policies, but financial institutions control capital flows that can undermine those policies. In the modern economy, capital mobility gives financial institutions enormous power. They can simply move money where they want, regardless of government preferences. National versus corporate interests. Corporations, especially multinational financial institutions, don't have national interests. They have shareholder interests. BlackRock doesn't ask, is this good for America? They ask, is this good for BlackRock? This isn't evil. It's the logic of capitalism. But it creates tension with national strategy. The limits of state power. The trade war showed the limits of state power in a globalized economy. Trump could impose tariffs, but he couldn't stop capital flows. He couldn't prevent Wall Street from expanding into China. In finance, private actors often have more power than governments. The Beijing Consensus China understands this better than Western politicians. Beijing doesn't try to control every aspect of the economy, but they maintain strategic control over key sectors, especially finance. Foreign firms can access Chinese markets, but always on terms set by Beijing. China maintains capital controls. The Communist Party has final say. Western economies have capital mobility and corporate independence. This creates opportunities for countries like China to exploit divisions. The future pattern. This pattern will repeat. Whenever governments pursue strategic policies that conflict with corporate profit opportunities, corporations will try to work around those policies. We're seeing it now with semiconductors, artificial intelligence, and other strategic technologies. Political leaders want to restrict China's access. Tech companies want to sell to Chinese markets. The tension is permanent. So why did BlackRock, JP Morgan, and Goldman move $1.4 trillion to China during Trump's trade war? Because they could. Because it was profitable. Because financial institutions operate by different rules than governments. The trade war was political theater. The real action was in capital markets, where Wall Street was placing massive bets on China's future. Who was right? Trump's tariffs or Wall Street's investments? The answer is complicated. The trade war raised awareness about China challenges, but didn't fundamentally change the economic relationship. Wall Street's bet paid off financially, but deepened dependencies that make strategic competition harder. The real lesson, in the 21st century, capital flows matter more than tariff rates, and financial institutions, not politicians, often decide where the money goes. Follow the money. It always tells the real story. Pause. If this opened your eyes to how global finance actually works, hit that subscribe button. We follow the money so you understand the real stories behind the headlines. The truth is always in the transactions, not the tweets.